What's up, guys? Brad here. So I want to share some nuggets that I picked up from Mohnish Pabrai's latest interview. That was done at the Investors Podcast and released on May 2nd of 2020. So hot off the press. So the first question they threw out at Pabrai was about the psychology of human misjudgment. And they asked, which bias do you have the hardest time dealing with? Now, in a previous episode, Pabrai had recommended Poor Charlie's Almanac as an incredible resource for investors. And towards the end of that book, Charlie gets into, all of these different biases that humans have that make it really challenging to do well as an investor. Now, Pabrai says these biases are very deeply embedded in our psyche. And as humans, we have to work very hard to deal with them. And he mentioned the tendency for self-pity, which I'd never heard him talk about before. But he mentioned a time early on for Charlie Munger when Charlie had lost his son to cancer, and how Charlie was just walking the streets, just feeling really sorry for himself, and how destructive that was for the rest of his life. And, we all have it. When we face adversity, we have this tendency to feel sorry for ourselves. And it can really do a lot of damage to our lives. So that's one that kind of jumped out for Pabrai. Now, in the next question, he's asked about meeting management. Is it a good idea to meet management when you're trying to decide on whether or not to invest in a company? Now, Pabrai, for most of his career, he never met with management, but he was investing primarily in U.S. companies. And the benefit of investing in U.S. companies is there's not a lot of outright fraud that happens with U.S. companies. So there's, the SEC, there's much kind of stricter regulations than there are in some companies outside of the U.S. Now, since he's been investing in a lot of Indian companies over the last 3 years, he's been doing most of his hunting in India. There's a much higher risk of fraud in India. There's a lot more cases of fraud in investing. And so he decided that he needed to meet management to deal with that risk of fraud. Okay. The issue is when you meet with management and CEOs, these managers, the reason they've been able to rise up in the ranks to management is because, they're incredibly charismatic, typically. They have super sharp sales skills. They're very likable people, okay? Now, when you're trying to make an investment decision on a company and you're talking to someone who's managing that company, who's very charismatic, really understands how to sell, that company within whatever industry it's in, it's very easy to, succumb to a lot of the biases that come up when you have an incredibly strong salesperson pitching their product to you or their company. So that's a challenge. And the way Pabrai deals with that is he's really focused on the track record of management, okay? And he tries to break down, what the management is telling him into facts, into things that he can, kind of remain rational in evaluating. So that's kind of Pabrai's tip for dealing with management if you're in a situation where you have to deal with management or it makes sense to. Another thing he mentioned is when he meets with management, say in India, and the CEO or the manager that he's talking to is very wealthy. Say they have hundreds of millions of dollars, right? So they're not necessarily hungry to create more wealth for themselves. And this is a challenge because if a manager isn't hungry to kind of accumulate more assets or accumulate wealth to the equity holders, to the shareholders of a company, that could be a problem if you're considering investing in that company and they don't have that hunger. Some of the management he's talked to, they're in kind of more of a capital preservation mode of their lives, and they're not going to be aggressively trying to grow the company. So that can be a red flag if you're thinking about a company as an investment and there's just not that hunger. And then Pabrai was asked about lessons learned. And really one of the biggest lessons that he learned back from 2008, from the last crisis, is he didn't fully appreciate the danger of leverage, the danger of companies using debt to fuel their growth, okay? Pabrai did a study of great investors, both now and in the past, and their investments that didn't work out. He wanted to study all of the investments that did poorly from these great investors and try to figure out, okay, were there red flags? Could we have seen that maybe there were some signs that these investments weren't going to work out before they were made? And what he discovered was the number one reason that investments don't work out is the business is using leverage, okay? And then he also mentions, this is a tip from Charlie Munger. When you make a mistake, you definitely want to learn from the mistake, but don't beat yourself up too much from that mistake, okay? You want to learn from it and you want to move on. You don't want to dwell on it because that can quickly lead to a downward spiral and cloud your ability to make rational decisions. Pabrai mentioned a book that he read by Daniel Kahneman, Thinking Fast and Slow. And Mohnish Pabrai, he thinks he has a very high ability to think fast. Like if a group of investors were forced to make a decision on an investment in 5 minutes, Pabrai thinks he would do very well compared to those other investors. But he's not very good at thinking slow. Now, when it comes to the world of investing, we don't need to make super fast decisions. There's time. We can, take in information and really chew on it for a while before needing to make decisions. And one thing that Pabrai wants to get better at is thinking slow, really ruminating on the facts, on the information available with the company. And so one thing he's implementing to kind of tip his thinking more towards thinking slow is when he comes across an investment that he really likes, he's had a tendency in the past to go all in on that investment, to put 10% of assets down right away on the new investment. What he's started to do recently is taking more of just a bite at first. So maybe he'll put 1 or 2% of assets into a new investment, and then 3 months later, if he still likes it, if he's still as excited about the company, put a little bit more. 3 months later, do the same thing. So he's starting to ease into the positions that he likes more slowly, with the aim of learning how to think, slowly, more effectively. Another thing he says, you don't know much about a company until after you own it, right? There's once you have skin in the game, it accelerates your learning about a company. And he says as well, if you have a simulated portfolio, it's not really going to simulate how you would actually be doing if you had real money at stake. You really get the learnings, you get the lessons once you have skin in the game and you actually lose your own hard-earned money. So it's important to have skin in the game. Now, this was a very interesting question. One of the interviewers asked, well, first he set this up. In 1965, the average tenure in the S&P 500 for companies was 33 years. So, of the 500 companies in the S&P 500, in 1965-ish, the companies would last about 33 years before dropping out of the S&P 500. In 1990, that dropped from 33 years to 20 years. And now it's projected by 2026, companies are only going to be lasting about 14 years in the S&P 500. And Pabrai was asked about how he looks at finding compounders in light of the fact that companies, they're not able to kind of fight off the competition or not able to maintain their dominance for as long on average in the current environment as opposed to, say, 50 years ago. So Pabrai's approach early on, actually for the majority of his investing career, has been find a company for 50 cents that's going to be worth $1 in 2 or 3 years. That's been his whole focus. Find 50-cent dollar bills. Now, there's some challenges with that. One of them is, if you're buying and selling every 2 and 3 years, the tax burden of that is going to be much higher than if you're able to find long-term compounders and you can just buy in and let it ride. Okay, so a challenge is you have much higher tax bills. Another challenge is you have to continue to be right. Say Pabrai has 10 companies in his portfolio. If he's selling after 2 or 3 years, each of these companies, he constantly has to be generating new ideas of companies that are, he can buy for 50 cents that are worth $1. So it's this, you gotta have a constant funnel of new ideas coming in order to keep getting these doubles every 2 or 3 years. And that's really hard to do. And you have to continue to be right on those bets, okay? So that's a lot of work and quite a bit of pressure as well. He also mentions businesses are very fragile. The odds that a company is going to last multiple decades, it's very low that you're going to find those. So that's the issue with buying and holding, right? You could say, finding the 50-cent dollars isn't great because you have to keep finding them. Well, finding these long-term compounders, that's hard too, because capitalism is brutal, and it's really hard to find these companies that are actually going to continue to grow, continue to compound for decade after decade. So, neither of those are very compelling scenarios for Pabrai. So here's what he came up with, and he's just been doing this for the last couple of years. It's kind of a new framework for him. He's not looking for cheap businesses like he was looking early on, the 50-cent dollars. And, you've got compounders that everybody knows are compounders, right? And those are too expensive. Those have high multiples, high price to earnings multiples. They probably deserve those multiples, but they're still too expensive. But there's a third bucket that Pabrai has identified. And these are the hidden compounders. These are companies that are compounders, but nobody really knows. Nobody is really able to identify them as compounders yet. Okay, they're hidden compounders. Pabrai was able to find 3 hidden compounders in 2019. A few of those were in India. Maybe one of them was in the US. He hasn't revealed which companies those are, but he found 3 in 2019, and he found 1 in 2020, in the first quarter of 2020. Like I mentioned in a past video, I'm really hoping that one is a US company, because then we get to see what it is in less than a week from now on May 14th, when the 13F filings are released. We're going to be able to see if it was a US company, which one it was, which company Pabrai thinks is going to, I think he said it was going to like 10x in the next 5 years or so, which is insane. I'm really hoping it's a US company. So those are all the notes I got, guys. That was really only the first half of the interview. The second half of the interview is a 52-minute interview. So I covered about the first 25 minutes. The second half was really on his charitable work with Dakshana Foundation. And that was really interesting. So I highly recommend, if you're at all interested in, how to donate to charitable causes in a way that's kind of in alignment with how Pabrai thinks about investing, where you're getting kind of your highest return. In this case, it would be like social return on capital. Highly recommend checking that out. I think that's it, guys. I just wanted to share these nuggets that I pulled from Pabrai's latest interview with the Investing Podcast. The Investors Podcast was released on May 2nd, so it's still pretty fresh. Of course, May 2nd was the Berkshire Hathaway annual meeting, and the Investors Podcast, they try to release Pabrai's interview every year on the same date as the Berkshire Hathaway annual meeting, in honor of the annual meeting. So that's all I got, guys. Cross your fingers that this new Pabrai addition to the portfolio is a U.S. company. And if it is, I will definitely be making a video less than a week from now about what that company is, why I think Pabrai sees such a runway, such profit potential in this company. All right, guys, stay safe out there. Have a great day, and I'll see you tomorrow in the next video. Take care.